Hi, I am Mr. James, and my mission is to help you prepare and perform at your best in your CSEC UE or KEEP accounting exam using the power of video. Welcome to another Mr. James accounting tutorial. This time we are looking at accounting unit 1 of KEEP, and I'll be doing the entire series of past paper from 2013 right down to 2019, and there was no paper in 2020. B-Ross started operations on 1st of June 2014 with a motor car purchased 3 years ago for 120,000. The latest valuation estimated the worth of the car at 75,000. On the same day, B-Ross opened a checking account at a local bank for 20,000. 15,000 of which were proceeds of a loan from M. Brown. After the first 6 months of operations, B. Ross recorded drawings of 17,300 and a loss of 21,500. Part E. State the meaning of the following accounting concept: historical costs, and Part 2. Prudence. The first, historical costs. Historical costs: all transactions that we recorded at the original cost to the business without adjustment for changes in the value due to inflation. Okay, the key words there are they are the original cost of the item to the business, and there are to be no adjustment for changes. And this is why we normally have two accounts for assets. One is to record the original cost or the historical cost, and the other is to record the depreciation or the change that may occur, the value of the asset or in the state of the asset. Next, we have prudence. Prudence is a reference to the frame of mind of the accountant when he is dealing with the figures. He must take a realistic view of the situation, especially where uncertainty and estimates are involved. He should neither overstate nor understate amounts. Okay, at this point, I should mention that there's a popular view that states that he should understate rather than overstate. Uh, Understating is no different from overstating, it's just as bad. And it is certainly not being prudent. Okay, so you should neither overstate nor understate the amount. Prudence is usually summed up in the following statement: record revenues only when they are earned and losses as soon as they are foreseen. Okay, so you have to earn your revenues first before you could record them, and you but your losses, you do the opposite as soon as you can foresee it. For instance, if you hear that one of your debtors has gone bad and he has a big account in your books, you have to write off the debt as soon as you investigate it and find out that it is true. Part B, what should be Ross record for the motor car in the books of the business? It should record 75,000. This is the original cost to the business. Okay, the 120,000 was not the cost to the business. This was the cost to Bureaus 3 years ago. But he's now bringing it into the business, and the value or the cost to the business is 75,000. Okay, remember what we said here? It must be the cost to the business. But C, Identify and explain the concept which allows B-Ross to record the motor car invested in the business as a non-current asset or a fixed asset. Part C, that concept is the going concern concept and the assumption that the business will continue to operate in the foreseeable future, more than 1 year. In relation to the car, the benefits of using will last for more than 1 year, and the going concern concepts allows us to record it as a non-current asset because it's going to last for more than 1 year. If the business was going to last for a shorter period, the value of the vehicle could very well be different. So the journal entry is required to record the formation of B. Ross's business on the 1st of June 2014. So what they require is the opening entry here. Okay, we can make one entry like this. An entry. So we know he's bringing in the motor van at 75,000, so we'll debit that. And we have here he's opening a bank account for 20,000, so we have cash in bank of 20,000. We know too that he has a loan for Embrong. A loan is a credit balance of 15,000. So when we put these together, the capital balancing figure would be 80,000 here. Okay, so assets minus liabilities, 75 and 20 will give us 95 minus 15 plus 80,000 as the capital. And the narrative to open the books of bureaus by recording the assets and liabilities at that time. Okay, so you must remember here the narrative is part of the journal entry and I should have it there as well. There was an alternative answer to that, also acceptable. You could have done it in two parts. The motor van recorded as capital to start, and the cash for the loan as another. The cash that you put into the checking account rather is another part of the capital. Okay, there's 75 here and a 5 here will give you 80,000. Show the closing entries now to record the loss and the drawings for the period. The loss, we are told that the loss for the period is 17,300 and a loss of 21,500. Now, if you don't know how to do a closing entry, you wouldn't know how to do this part. It's just something that you would have learned way back in Form 4, opening and closing entries, right? What you have to do is transfer your profit to your capital because profit increases capital. In this case, he has made a loss and that will decrease his capital. You still have to transfer it to his capital, and his drawings also will decrease his capital, and you have to transfer that as well into the recording the drawings and the loss in the general journal. You debit the capital, this will reduce it, and both items, the loss as well as the drawings, would reduce the amount, and you close to close off loss and drawings to the capital account. Now this too could have been done in two parts like this. One part for the loss and one part for the drawing. The management of bureaus intends to operate a paperless environment and hires a trainee accountant. Within the week on the job, the trainee accountant is seen to be consistently using BlackBerry Messenger while working. In addition, the trainee occasionally logs on to Facebook using the computer on which the financial information is stored. Outline three controls that the management can implement to ensure the integrity of the accounting record. Okay, uh, they require three. I give you four here. One, you give clear guidelines on the use of communication devices. You should make it clear to the employee what your guidelines are for the use of communication devices. Restrict access to sites with social media, personal email, etc. on your computers. Right? Make sure that you cannot get into the social media when you're not looking, but by placing restrictions on it, like passwords and things like that. Institute a system for monitoring employees' online activities. So you must have a formal system, right, for monitoring all your employees, not just the trainee accountant. And if in perchance some of them still manage to get in, you have to be able to back up your recovery and recover your information in case they go on to sites that have virus and so on. So institute a system of backup and recovery of information in case of virus attacks or loss of information. Using table 1 provided as an insert, show the effect of each of the following transactions in the cash book and statement of comprehensive income of business limited for the year ended 30th June 2014. If the accrual basis of accounting is used, one example has been done for you on the pay rent of 6 months ending 30th September 2014. This particular one was done. The insert looks something like this. We have the numbers of the different items here and the cash book and income statement at the head in the air. Right, the first one was done and it said this decrease of 12,000, and the income statement said increase in rent expense 6,000. You might want to ask what happened with the other additional 6,000. Well, according to the dates here, it would have been prepaid and would not have been in the income statement. Okay. The next item said bad debts 1,500 written off during the accounting year. So that will have no effect on the cash book because it does not involve either cash or checks. And on the income statement, we would have an increase in bad debt expense of 1,500. The next item, fixtures purchased for 74,000 on 2nd of July 2013 by check. Okay, so this is in the first month of the financial year, 2nd of July, and it's going to decrease our cash at bank by 74,000. The income statement, on the other hand, will have no effect. Depreciation of fixtures purchased on 2nd July 2013 is charged at a rate of 15% using the straight line method. So these fixtures here, 74,000. It's at the beginning of the year, 2 days inside the year. So we will charge a whole year's depreciation on it. It will be 15% of 74,000, and we will get 11,100. Increased depreciation of 11,100. Invoice for electricity amounting to 3,700 on the month of 30th of June 2014, not received nor paid. So it does not have any cash involved there, so it will not affect the cash book, and there would be an increase in the electricity expense of 3,700 in the income statement. Amar, Mohan, and are equal partners in a retail clothing business. They each contributed $240,000. After it was agreed that Lee should join the partnership with all three partners sharing profits equally. For the purpose of admitting the new partner, the goodwill in the business was valued at 180,000. Goodwill is not to be maintained in the accounts. Lee brought in cash of 160,000 into the business. Prepare the capital accounts of the partnership, showing clearly adjusted balances after the admission of the new partner. Okay, now this here is the partnership account. I've done it already. I'll go through it with you bit by bit. Amar Mohan Lee partnership capital account. So, okay, this side here is the debit side, and this side here is the credit side. Um, the balance brought down 240,000 and 240,000 to Amar, E for Amar, and M for Mohan. L is for Lee. Lee was not in the partnership at the beginning, so he does not have any capital here to bring down. So only Amar and Mohan. Next, you are going to apportion the goodwill in the business up until the time Lee comes in. So it means that goodwill is only going to go to Amar and Mohan. They are alone going to share it. And it's 180,000, and they are equal partners, so they will get 90,000 each. Lee will not get any because he did not help in the creation of that goodwill because he was not in the partnership as yet. Next, Lee is going to come into the business and he's going to bring $160,000 in cash. So we put in the cash here into Lee account and the cash here into Lee account. Next, he is going to receive a portion of the goodwill. So we need to divide this goodwill now into three persons when we are removing it from the books. And three equal portions will give us 60,000 each. And that's this entry here. Okay, so this 60,000, 60,000, 60,000 will come out of the books to remove goodwill from the books. And after that, we can balance the account and we will get the balances here, the adjusted balances after the been admitted to the partnership. So when we balance the account, we notice that Amar will have 270,000 and Mohan 270 and Lee 100. Although he has brought in 160,000 into the business, he is his account is only showing 100 because 60,000 in goodwill has been removed from the business. The same applies to Mohan and the same applies to Amar. Their balances would be 60,000 short because goodwill has been removed from the book. Coming up next, part B, the stay wrong. Part B, distinguish between corporations and cooperatives in terms of the following characteristics. 1. Transferability of ownership interest. 2. Voting rights. 3. Purpose. And 4. Legislation. Okay, first let us look at transferability of shares, corporation, and the cooperative. Ownership interest is transferred by sale of shares on the stock exchange to anyone who holds shares in a corporation. And in a cooperative society, ownership interests can only be transferred by permission of the management rules and usually to family members only. Voting rights, corporation, cooperative society. In a corporation, voting rights are according to common or ordinary shareholding. And each ordinary shareholder is entitled to attend the meetings of the company, and every share held carries one vote. In a cooperative society, on the other hand, voting rights are according to memberships, with each member getting one vote. Shareholding is not considered as a right to vote. A corporation, the primary purpose of a corporation is to benefit its members or its shareholders. Usually, this means shareholder wealth maximization. That means you are setting out to maximize the wealth of the shareholder. You take the amount that he has invested in the corporation, and the management will look to maximize that wealth production from that. Cooperative, on the other hand, main purpose is also for the benefit of the members, but only by pooling of the resources of the members. Usually, the cooperative is organized around a common economic goal. Legislation. Corporation. In the English-speaking Caribbean, corporations are regulated by the Companies Act in the various countries. The cooperative societies are regulated by a separate Cooperative Society Act. Coming up next, the statement of comprehensive income. So stick around. Subscribe, like, comment. Okay, we are given an adjusted trial balance for Poindex Limited as of 31st May 2014. It's in a columnar form, so it does not tell us which side is debit side or which side is credit side, or even if it balances. But let's see what is required first, then we will know how to proceed. Prepare a statement of comprehensive income for Poindex Limited for the year ended 31st May 2014 and identify the figures to be included in current assets, current liabilities, which would appear in the statement of financial position as at 31st May 2014. So it does not require the entire balance sheet, just the current assets and the current liabilities. And it also does not ask us to conform to IAS or IFRS standards. Okay, so we can use any format we wish to. Poindex Limited depreciate all assets at a rate of 10% per annum using the reducing balance method. Depreciation is normally allocated 40% to distribution and 60% to administration. So we notice that the depreciation is already calculated 101,000, and we will have to allocate that 40% and 60%. And also we are seeing a loan here of 735,000, a 15% loan, but there is no interest given on the loan. In fact, there are no financial expenses. So we will have to assume in this problem that the interest on the loan has not been paid yet. Okay, let's move on next to the working. Now we have the workings. We start first with the selling and distribution. The balance in the trial balance is 125,435, and we add the depreciation of 40% of it is 40,400. So the new figure for your profit and loss account will be 165,835. Then we have the administration brought forward, 234,195 from the trial balance, and we add the depreciation 60%, 60,600, and we also are going to write off the research costs, which we see in the trial balance there, and we get 310,465. Now, concerning the research cost, the normal position of that is either you capitalize it in your balance sheet and you are going to write it off on a regular basis over a number of years, or you can write off the entire thing in the year of occurrence. What I have chosen to do here is to write off the entire thing in the year of occurrence. Pointex Limited statement of comprehensive income for the year ended 31st of May 2014. We need 3 columns. Sales, that's the cost of sales. Inventory, 1st of June. And the purchases go in a new column, so we can minus the returns outwards from it, and the discounts received. The net purchases is 387,300. That is this figure for purchases minus the returns and the discounts. And we plus the inventory from that, and we got the cost of sales. So it's a pretty simple affair, this income statement. 508,000. I will do it in 2 slides, so the other part coming after the profit and loss section follows immediately. Other income, 35,000. The total gross income, when we add the other income to the gross income, we will get 543,000. Okay, so the total gross income of 543,000. The operating expenses, selling and distribution, 165,835 from our workings. Administration 310 465 from our workings again, and the total operating expenses is 476 300, giving us net income before tax and interest of 66,700. Now, depending on how we interpret the loan, we will proceed from here. If we take the loan as the interest being accrued, then we will have to minus the interest here, and that is 110,250. So we end up with a net loss of 43,550. And you don't pay taxes on a loss, so you can't take 25% of this. But if we assume that the interest on the loan is not accrued, then what we have to do is charge the tax on the $66,700. Okay, so coming up next, the current assets and the current liabilities. We look at the current assets. Inventory on the 31st of May, that's at the end of the year 2014, 145,300. Then we have the accounts receivable, 405,000, giving us a total of 350,000. These and the accounts payable is 79,750, tax payable 7,500, and the interest payable 110,250. And giving us a total of 197,500 to be shown in the balance sheet as current liabilities. Stick around, Module 3 coming up. We are given some financial statements here. A statement of comprehensive income first, and it's for Cisco Limited. It's a condensed vertical format. Also have the statement of financial position on the balance sheet, again in vertical format. However, it does not give us the working capital. Okay, let's see what they require for prepare common size statement for Cisco Limited. From these, prepare a report to analyze the performance of the company. Your report should focus on liquidity and profitability by using a two ratios in each category. Calculate ratios to two decimal places. Now I remember when we were marking this, most people didn't know, including the teachers, did not know what common size statements were. Although it was on the syllabus, most of them confessed to not knowing what it was or neither teaching it. Okay, well, let's take a look at what common size statement is. And common size statement looks like it's an income statement in vertical format, and the percentages are in a column alongside it. Um, this is used when you are performing vertical analysis on your financial statement, right? One of the items, either the revenue, cost of sales, or the profit, is chosen as a base. In this case, I have chosen the sales, and that is would be 100%, and the other figures expressed as a percentage of the sales. I have calculated all these here as a percentage of the sales. So what you can do as an exercise for you is to verify these figures before you write up your report. Okay, so your common size statement would look something like this. It must be done in vertical format. We do the same with the balance sheet or the statement of financial position. We have the balance sheet here, and then we have the percentages here. In this case, I have chosen the total equity or the total net asset to be the base, and I have calculated all the relevant items on it. Then we only have one type of shares, and the retained earnings and the reserve would belong to those shareholders. Then we don't need to really calculate the percentages here. So only those that are meaningful to us we would calculate. And since we are required to calculate profitability and liquidity, I have done these here on the non-current assets and the current assets and liabilities. I have put in the working capital because it's in a very precarious position here. Only 3.51% of the total equity is working capital. That's the capital that works in the business. Okay. And from this, we will write up our liquidity report. Okay, let's take a look at the report on the profitability and liquidity of Cisco Limited. We'll look at first at the profitability, and the sales margin was 30.78% as the gross profit percentage. This is before paying operating expenses of 18.85% and leaving Cisco with a profit before interest and taxes of 11.93%. The ratios are based on the net sales of the company. Now, you may want to say more than this, but it is not really possible to say more than this, right? Why? Because of the unavailability of comparative statement. It was impossible to say more than the above about the profitability of Cisco Limited. Okay? You can't say much more than that because you don't have any figures to compare it with either for the previous year or the year after. And I don't think you were expected to say more than this. The return on the capital employed was 2057 over 4728 multiplied by 100 is 43.51% before interest and taxes, and 899 that's a net profit over 4728 multiplied by 100, 19% after interest and taxes. And again, you can't see much more than that there. So for 14 marks to prepare on profitability and liquidity, you wouldn't be seeing very much here because most of your time would have gone into the preparation of the common size statement. The current ratio, and you can look back at the data and see that it works out to this, is 1.05 to 1, which indicates that Cisco Limited is experiencing liquidity problems. A good ratio is usually 2 to 1, right? And this is below that. Okay. If we look further, the asset ratio is 0.87 to 1, which means that they cannot pay their current liabilities without utilizing the inventory. Okay. So a good asset ratio is 1.5 to 1. So Cisco Limited is definitely experiencing liquidity problems and it could get worse. Part B, list three limitations of ratio analysis. So 3 marks. I have given you 5 here. The inherent problem of comparability, use of different accounting policies and methods. Okay, so in order you have difficulty comparing uh, ratios where different businesses use different accounting policies and different methods. 2, they are sometimes based on figures which are subject to deficiencies such as aggregations, approximations, estimates, and even manipulations. Okay, that is about self-explanatory. Three, use of historical information is limited by inflation and other changes in the value of the dollar. Right, historical information, we know we have to use historical costs as one of our concepts and convention. Four, numerator and denominator of the ratios can also influence the interpretation. Right, what do you choose for your base? For instance, we just look at the vertical analysis, and we saw that we could choose which base we want to and calculate the ratios on the basis of it. Okay, so numerator and denominator can influence the interpretation. Five, economic conditions, industry situation, size of firm can influence information as well. Part C, Section 32 of the IFRS for SMEs define events after the end of the reporting period as any event that provides evidence of conditions that existed at the end of the reporting period. And we are asked to do two things: outline two examples of events that would be disclosed in the financial statement as required by Section 32. Now, that would need a bit of explaining what is required here. First, the Section 32 deals with post-balance sheet events, right? You have two types of balance sheet events. One, you have the adjusting events, and then you have the non-adjusting events, right? And if for those items that are non-adjusting events, they are dealt with in Section 32. For some of them, if they are material, you have to disclose them in the financial statements. And for others, if they are immaterial, you can simply ignore them. Okay? And part two, explain the meaning of conditions that existed at the end of the reporting period and give one example. Okay, so they want to know what is the meaning of conditions that existed at the end of the reporting period. First, this piece here, I'll give you a little information about Section 32 and what it is about before I jump into the answer, right? Events that would be disclosed in the financial statement as required by Section 22 are called non-adjusting events. They relate to conditions that arose after the end of the reporting period, that is, after the balance sheet date, and therefore should not be reflected in the financial statement. However, disclosing information in the notes to the financial statement about significant conditions that arose after the end of the reporting period is relevant in assessing future cash flow. This is one of the objectives of of preparing financial statements, assessing future cash flows. Users want to do that. Okay, and then we have the relevance, right? So you need to disclose some items in the financial statements notes if it is relevant. The first outline, fall in the market value of investments between the end of the reporting period and the date when the financial statements are authorized for issue. The decline in the market value does not relate to the value of the investment at the end of the reporting period. So, in other words, you don't need to report it it's a non-adjusting event. You would not adjust the financial statement for it. However, if the item is material enough, you may want to disclose it in a note to the balance sheet. right? So we have a fall in the market value of investment. These investments were on the balance sheet during the reporting period, right? So, and after the date of the balance sheet, the value fall. So, what will happen is the value after the balance sheet date during that interim period when you are going to report while you are preparing your final accounts to report, the value of the investment fall. Okay, and so the only time you would report that in a note is if it is material enough. Two, a material receivable has arisen as a result of the settlement of a court case after the reporting date, but before the financial statements are issued. This is a contingent asset and disclosure is required, right? So, okay, so you would want to disclose this in a note to the financial statement. However, you will not be adjusting your accounts because of it. Two, that is the condition, an explanation of the condition that existed at the end of the reporting period. Right? It means assets and liabilities recognized in the financial statements at the end of the period. That's what it means. And also, it may mean expenses or cash flows. We must remember cash flows recognized in the financial statement at the end of the reporting period. Okay, so that is what it means when it talk about conditions, right? The status of assets and liabilities and income and expenses, cash flows, for instance, on the financial statement, right? Example, a material amount receivable recognized at the end of the reporting period becomes uncollectible before the date of authorization of the financial statements. Okay, so you have this receivable on your balance sheet at the end of your reporting period, and before you could issue the report, it becomes uncollectible or is a bad debt. Turns out to be a bad debt. What happens is you can't collect it, and that is talking about conditions that existed at the end of the reporting period. Require us to list three duties of a receiver in a bankruptcy situation. And then we have part two. In dealing with the claims of an insolvent business, the liquidator must first pay any outstanding national insurance, social security funds which had been withheld from wages, followed by claims of secured creditors, claims of partly secured creditors, and lastly unsecured claims before dealing with shareholders. Okay, so shareholders get their money back last. The list falls into three categories shown in the headings in Table 2. Right? First, let us look at this. What it's saying is the saying that money owed to the government must be paid first, right? And then you have secured creditors, partly secured creditors, and last unsecured creditors. And if anything remain back, then the shareholders will get that, right? So first, let's look at the three duties. Three duties of a receiver. One, inform debtors and creditors of the firm of his appointment. Two, he takes custody of all the assets of the firms. And three, he opens a bank account to facilitate receipts and payments under his receivership. Right? He wouldn't use the firm's bank account for that because he doesn't want his business getting mixed up with that of the day-to-day running of the business. right? Now the table that they want us to copy would look, this is what it looks like. This is the actual table cut out of the paper. I will not be using it. I will just put in the to the side here whether it's secured, unsecured, or partly secured, right? Here, but this is what you had in the exam, and you had to write in the items underneath. Okay, so the A, unsecured bank loan, uh, right? That would be an unsecured claim. There is a clue, big clue here. Accounts receivable of 40,000 has been pledged as security for a note payable of 120,000. 40 out of 120,000 is secured, so that is partly secured claims, wages and salaries payables, unsecured. Robin has used her shares of the cable incorporated value of 75,000 as security for a business loan of 75,000. So Robin must be a shareholder and she takes her share certificate and uses it as security for her own business. Okay, to get a loan of 75. That has nothing to do with the thing, so it's still an unsecured claim. The utility bill for the water and sewage authority is unpaid, unsecured claim. Davis Garage has a charge on a car owned by Philip Patel, right? So he has a claim here. So this would be a secured claim. Accounts payable is an unsecured claim. Okay, so that would wrap up our module 3. Hope you find this video helpful. So you would want to give it a thumbs up. If you don't, you can give it the thumbs down. Here, YouTube is taking away the thumbs down. So this is probably your last opportunity to give a video the thumbs down. See you in the next video.